Namaste and welcome to my show Concepts with Karan. And today मैं बहुत super excited हूँ and very happy also because I have one of India's most intelligent minds on managing money, none other than Sailesh Bhan, the Chief Investment Officer at Nippon Mutual Fund. And I'm really excited about this opportunity to talk to Sailesh because there's so much to learn from him and also so much to discuss with him. And just before we started the shoot, we were discussing and we were talking about style of investing. और आपने एक बहुत अच्छा word उसके लिए इस्तेमाल किया, which is neither growth nor value, but sensible style of investing. I would love for you to start with that and explain to everyone what did you mean by that?
See, investing, the underlying principle of investing is, buying something at a reasonable price, which, you can expect that, it can earn you returns over a period of time. So it's about more paying reasonable, sensible pricing to buy sustainable, good quality businesses. So it's like sustainable, good quality businesses at reasonable prices. So here there is no context of saying that you're buying an inferior quality business. You're buying a quality business. Only thing, you're paying the reasonable right price. So that when you do the investment, you at least have at the back of your mind that this business can give you an XYZ return if these kind of earnings happen. When you're paying extremely high prices, you are not even able to justify to yourself that these investments will give you a decent return over a 3-5 year period. So we avoid those investments. So within that, our approach is don't overpay for growth. Value growth, pay well for growth if it is sustainable, but don't overpay disproportionately, which happens. Generally, we have seen, various companies, they just re-rate to very high levels and then they don't perform for 10 years. So our principle there is don't overpay for growth, pay sensible price and valuation for growth so that you get a IRR which you can justify for your portfolio.
In that format of sensible style of investing, what you're saying is you're not really married to a particular style. It's neither growth nor value, but something that you think as a manager of money could create wealth for you over time. Is that correct?
For example, we see ourselves as more growth at reasonable prices. So over cycles, markets normalize. Markets go in a frenzy where certain businesses are overvalued by a huge margin, and then they go through a phase where businesses are undervalued by a significant margin. Our idea is to take advantage of these and invest in quality businesses. So these market gyrations, as we call them, we get advantage of that as if you're an investor with a medium-term time frame. So our approach is to keep getting this right over longer periods of time. And we don't know, neither do we control market movements, nor do we totally understand them, because they happen for many factors. Like, we had a period of extremely low interest rates for a long period of time. 5 years prior to that, nobody would have ever thought that India or globally the world would have such low interest rates for a long period of time. So these are things which are, I would say, non-controllables in some factor, and they may shift prices way higher. So our idea is not to get bogged down to saying that this is a current condition, it will remain forever. It is for us to buy at reasonable prices and take the risk reward, understand it appropriately, and then take a decision. So it's not sticking to one. It's actually wherever there is an opportunity which is in quality sustainable businesses is what we focus on.
And sometimes that could actually mean being counterintuitive to what the market could be saying. Any such example, and one of the things that we were discussing is also the way the Nippon funds, the entire range, really come back into reckoning with some fantastic performance numbers. So now we're seeing that the way Nippon's entire equity basket's really kind of ramping up on performance. So there must have been a period where you all invested first, let it kind of build for a while, and then the numbers are showing up. Do you want to take us through that journey or a little example around that?
See, certainly when you're taking 2 or 3 or 4 year calls, right, there'll be phases where, you may not be able to capture the returns immediately. So our idea, like I said, is not overpaying for growth. So when does that come about? When the market doesn't like those businesses, when those businesses are not in favor and they're available at reasonable prices to really participate in. So we continuously have looked at these opportunities. For example, we were way earlier invested in the engineering space versus where the market today is in terms of valuing them. So the idea is to see that can you do it in high quality businesses, leaders in those segments, when they are out of favor or not really keenly researched by the marketplace, that provides us a reasonable entry price for those businesses. because of COVID, some of these sectors might not do well, or some event happens like COVID happened. Some sectors don't do well in that 6-month, 12-month period. But that is where your conviction comes into play, that when there is a recovery in this particular space, you end up benefiting for sure, because you have owning leaders in the category. You're not owning companies with bad balance sheets or any challenges. So selecting leaders, taking the right risk, and staying through the conviction in extreme conditions is what really has helped us over a period of time.
Yeah.
Same has happened in the hotel space, where we were invested in the leaders in the sector. And because of COVID, we saw significant corrections. But when we stayed put to those, I think they have delivered very well for our investors.
And both of them are really diverse examples that you give in engineering and hotels, and actually both may have been underowned for a very long time before they actually have come into mainstream. And
these under ownerships have led to reasonable valuation. See, if everything is over-owned or well-owned, it is well-priced.
Absolutely.
So then, making returns on a well-priced stock is not easy.
It's almost not going to generate.
Then you're playing pure luck. When you're taking the right risk and buying them at reasonable prices, then you have an element of skill involved in it.
So then, how does one kind of solve for this high quality but expensive? Because there's always this tussle between, whether it's the judgmental call on quality and valuation. Like, any thoughts on that?
Stocks are nothing but just a collection of future cash flows you're buying. So it's about the certainty of cash flow, the size of cash flow, and the growth in those cash flows that determines the valuations which are there. Now, within these frameworks and these assumptions, if valuations don't fit, there's no point owning the best business in the world also. But within these assumptions, if the valuations fit, then it's worth owning. So a company growing faster at 30-40% and can sustain for 3, 4, 5 years based on your research ability to understand that market, then it's good to pay well for that business. But for businesses which can grow very low, 10, 15%, 12% kind of growth rates, and if they are valued very expensively, where if they come to normal multiples, you may not make returns for 5 to 10 years. So the idea is to really pay sensibly for these businesses, and in one way, not overpay for growth. See, nothing will be cheap. So there'll always be pockets where there is euphoria, where there is momentum, where there is, I would say, narrowed participation by the market, and that gets to levels which are, as people call them, melt-ups in stocks. They just go to extreme levels. Our idea is to use the market to our favor to exit some of those businesses and participate where there is opportunity, where an ignored business, high quality company, but not in favor because next 2 quarters are bad. So that's how we keep finding relative value within the marketplace. And if at any point of time, if investment is generally able to deliver 15-18% IRR for us, because equity expectations minimum generally for any investor coming in generally happen to be in that range. So if it can give that kind of an IRR, we are okay with it. But the minute it drops very significantly and you don't expect returns for 3-5 years, we may not participate at that point of time.
It's interesting you use the word melt up and sectors melt up, etc. And so there are 2 questions that I have. One, you spoke about engineering and hotels as you invested ahead of time. But then there are also now sectors where the melt up is happening. Any sector that you see where the melt up started? And then I have a follow-up question.
So some areas, like for example, when businesses are completely out of favor, they really go down in valuations. From there when they go up 5, 6, 7 times in 2-3 years, they become expensively valued, where from there on getting disproportionate return is not easy. So even if everything goes right, you may end up with very normal returns. So that today is possibly happening in select engineering businesses also. Because a lot of these businesses have gone up 5, 6, 7x in the last 3, 4, 5 years because of the valuations they were trading at before. And now with the businesses also doing well, the economic environment also doing well, but still you are paying so much for it that your return expectations have to moderate. It had happened in new age companies some time back, the melt-up phenomena or whatever, in the sense, at least the IPOs were at extremely high valuations, which has not worked. So we are very careful of these melt-up categories which are there. They give you very swift return. But if you are a part of that journey, and if you're not able to exit at a reasonable point of time, then you have challenges. So our idea is never to get the top so correctly. You need not get the top correctly every time. If you're above average in your exit also, it helps a lot.
Yeah. So just coming to this engineering example, and again, not not stock specific, but you did mention that you all invested ahead of time, but now you see that it probably is kind of overvalued. So what you're saying is you would have taken decisions to exit as well, and then obviously reallocate capital to something else. Is that a fair?
Yeah, so
assessment?
our approach to any sector, in this case engineering and all that, where valuations or return expectations at that point of time they reduce, either because earnings growth is not strong or because just valuations are factoring in too much of it, we take corrective action. So we may reduce the weight depending on where the valuations stand. We may shift to relatively attractive sectors which are not necessarily similar kind but relatively more attractive sectors which may offer much better risk reward at that point of time. So we do take these measures. So suppose we were owning a larger weight in a particular industrial stock, and if valuations have just gone berserk and which even we cannot justify to ourselves, we reduce our exposure significantly, and which we have been continuously doing.
So I just wanted to shift focus a bit and kind of speak about this events across the globe are now starting to having a bearing on investor returns. And I know the core theme of most fund houses is to be bottom-up stock pickers. Now, how do you marry what's happening globally and bottom-up stock picking? Because it's not easy to have both simultaneously. How do you juggle with that then?
See, international events, because today in any market, especially in Indian market, there is significant international capital flowing through also, and there is significantly fast flow of information across markets. So anything happens anywhere in the world does have an impact, at least in the near term, on Indian equity markets. So our approach is, if we are able to gauge the impact of it and assess it, we reduce the riskiness of the portfolio, or we become a little more risk averse in the strategy which we run. And if there are events like COVID and all, where we have very difficulty in understanding what's happening, right? In those cases, we just increase our diversification across so that we lower the risk, and anything works helps us participate in. Secondly, the principle of not overpaying for growth at every point of time by itself lowers the risk. So there are a lot of known knowns and there are a lot of known unknowns, and then unknown unknowns are what all these COVIDs are, right? So our idea generally is to see that what we understand, we can act on it. What we don't understand, we attempt to diversify as much as we can, and then don't let go of the principle of not overpaying for growth. So you have three layers which supports us. As you look at it, stock picking, generally there is a perception, or there is a results which we have seen is like far more understandable. Maybe not in very short periods of time, but over rolling periods of time, because you focus on more fundamental factors like domestic earnings, demographic changes. You focus on factors which are there. The ability to capture returns out of stock selection is much, much higher than trying to capture over macro movements which happen. So generally our effort is to see what we can control, or what we can better able to understand, put greater energies to it, and use macro events and all to manage the risk in the portfolio.
I think that kind of makes sense. So I just wanted to come to the last section of this talk, which is India, Bharat.
Sure.
And how do you view the next decade or two, both as an investor and as an institutional investor and as an individual, because both the perspectives matter. Are you seeing something that we've not seen earlier in the country by way of possibilities of wealth creation? Anything that you'd like to share?
The biggest opportunity lies in the fact that many businesses in this country are very, very small for the size of the population. Maybe they reflect the income levels the country has today, but I think the reality is many businesses are way smaller than they would be in developed market. And our construct of our country is reasonably strong. We have seen some of the best managements in India. We underestimate that fact, but we also have fantastic businesses and entrepreneurs running the businesses here.
Right, absolutely.
And we have a very strong regulatory framework around it, which in a way is very important, as you have known what has happened in some countries of late, that you've had challenges in terms of how the regulatory challenges which come about, where shifts in policies happen so quickly. India is far more stable for an emerging economy and far more I would say, balanced in that approach, right? And that allows businesses to, those who do well, those who have great governance, do well over long periods of time. So that opportunity for wealth creation remains. It is as good as it used to be even 10, 15 years back, because at that point of time, our market caps and valuations and businesses were much smaller. And even today, we may find that it's grown so big. But the reality is, on per capita basis, say for example, the mutual fund, maybe we would be what? Only 4-5% of India invests. And it's become a 30-40 lakh crore industry. But I think there is a long journey if you get income levels right. The basic demographics are taken advantage of. I think it's a very, very long journey to participate in. So completely positive on what can really happen in the next few years. And especially after seeing how, despite difficulties in the last 15-20 years, how we have grown.
So true, so true. There has been wealth creation happening at
Absolutely.
at every point in, I mean, over 10-year periods. And that's reflected in, it's actually reflected in your funds. They have 27-year track record, and I'm looking at the numbers, 22% CAGR. Some of them have gone up 220 times. This is quite phenomenal actually since inception. I don't think anyone's had a 220 times increase anywhere in the world. So, last thing, Sailesh, who is your role model as an investor? Like, who do you really look up to? Any names from that you'd like to share, both here or globally?
See, we have learned from a lot of people, because this was not a field that existed when we entered the industry, in India at least. There was nothing like equity research or, about 25-30 years back, at least in the scale. And so we learned from, generally we started learning from what was internationally available. Mr. Buffett has been a big influence across, I'm sure, for everyone and for us. So similarly, we've run through people's philosophies, what they have done and what's worked, what's not, where things have failed. So it's been a lot of help from all this. So Mr. Buffett certainly has been, in a manner of speaking, because he used to write a lot on this particular aspect, and which allowed us to look at, and understand. Then we have worked with some fantastic colleagues over a period of time. So we've learned from a lot of them, because everybody has a different style, and everybody is generous in sharing their thoughts. So it's been across the board learning which has happened over periods of time.
Yeah, and I think you all have had some phenomenal talent over the years, and you obviously been right through that journey. So yeah, so much depth available. So on that note, Sailesh, thanks so much. Really enjoyed talking to you. And for everyone listening in, sensible investing, not overpaying for businesses, is the best possible format of risk while you're investing in equities. And I think the point Sailesh made is take a decadal view on this nation and create wealth with Nippon funds. Thank you so much.
Thank you so much, Karan. Thank you for having me.